What to do, what to do. This is the Brothers on Books podcast, where we find great books that will give you real value and actionable steps and have fun in the process. Please reach out to us at brothersonbooks@gmail.com for any book recommendations, or if you would like to be a guest host for a particular book you have in mind. A great review or rating on whichever platform you're listening to would be greatly appreciated. And lastly, if you can think of any friend, family member, or coworker that might like this episode, please pass it along. I'm Alex Allweil, and with me, as always, is my brother Jack. And Jack, today we have a special guest. Would you like to introduce him?
Sure. Yeah, today we're discussing Mapping Out the Millionaire Mystery by Brent, Kessler, and Chris Naugle. And we were fortunate enough to get Chris to join us today. Al, I think you heard about him from, was it the Millennial Investors podcast?
Yeah, so I guess, Chris, the first time I ever heard you talk was one of your interviews with, I think, Robert Leonard on Millennial Investing off of TIP. And like most things, when I first heard you talk, I was like, man, what you're saying just sounds too good to be true. And when I am financially confused, the first thing I do is, I guess, usually ask the more experienced and wise brother, Jack. So I sent him the episode and just asked for his thoughts. And, here we are, like probably, I don't know, 5 or 6 months later interviewing you. So,
yeah, I remember I was in Vienna at the time and I was walking around and I was kind of embarrassed a little bit because this is kind of like my actuarial world and like the personal finance stuff kind of blending together. And I'm like, wow, is this actually possible? And so with that, we'll get into it. Chris, welcome to the show. It's great to have you on.
Yeah, I'm honored to be here. And the fact that you're an actuarial, like that's definitely going to make this really fun because we can get in the weeds a little bit and go down some rabbit holes.
So sure. How about you just start off, give a little bit of your background and how you ended up being so passionate about whole life insurance.
Yeah. So, well, it definitely didn't start that way. Growing up, we didn't have money. And if I wanted something, all I had to do is I had to get resourceful. I had to go out there and find a means to make it happen. But the one thing my mom did that was the best thing she could have ever done for me is she taught me to dream. So everything I wanted, whether it was a skateboard, a snowboard, a BMX, or a dirt bike, I would draw it out and I would fixate and focus on it nonstop. Even at school, I probably got in trouble by teachers because I was just drawing, the act of doing this. And that carried on throughout my teenage years where I got this idea of being a pro snowboarder. That was the only thing I cared about. Now I live in Buffalo, New York. It's not exactly the prime pro snowboarder area, but there was 2 guys that I knew of that had done it. And I said, you know what, there's a way, and we get plenty of snow. So in this journey to doing this, I was working and I didn't have the money to go to the resorts. So what I would do is go to the country club, and the country club was in a ravine. We had this country club with a ravine, and I would go there after school, and out of the sand traps, I would build jumps, and I would practice every single trick that I learned by watching videos. Well, back then there were VHS tapes, and watching and reading magazines. So I did that for years, and I just kept fine tuning all these tricks. And I eventually ended up becoming a pro snowboarder. But before I became a pro snowboarder, I actually entered the workforce. At 16 years old, I became a prep cook at a restaurant. And it's like most 16-year-olds, the only people that will hire you are restaurants. And I did that, and I hated it because the guy degraded me so badly to the point where I was literally clinically depressed. And I remember the day, I'll never forget this day. I came in and I quit. And I remember that was the moment where I quit trading hours for dollars. I came home, told my mom, and I said, Mom, I want to start a clothing line in the basement. So that was my first embarkment into, entrepreneurship. I started a fat clothing company out of the basement, printed a dozen t-shirts with my art teacher, Mr. Mahalski. And that was where it all began. Fast forward to 18 years old, or 17 to 18. I had been selling my clothing, doing well. And then I got this idea to open a skateboard, snowboard shop called Fat Man Board Shops. And all I needed was 70 grand. Now, again, I told you I came from a family without money. So that ended in lots of no's and lots of dead ends until my mother saw this dream fading and dying. And she finally made a decision, which I think looking back was a really stupid decision. She decided to put her house on the line so that I could chase that dream and open that snowboard shop. So 5 years, well, it was the loan amount. So 5 years I had mom's house on the line, but I made it. And that store went on to be successful all the way into it's still successful today. I sold it in 2010. But during that, I ended up in 2000s, I was a pro snowboarder. I had, I think, 2 stores going at that time, 2 or 3. And then the .com recession hit. Now, I'd never even had a recession. I didn't even know what the word meant. I was a pro snowboarder. I mean, what the heck do I have to do with recessions? And then it hit, and I realized, holy crap, I better get a job. So I either was going to deliver pizzas or put my resume out. And I ended up getting, and I'll use the company name just because you were an actuarial. I ended up getting 2 replies to that resume. And both of them one was a life insurance company and one was a kind of a Wall Street firm. I'm not going to give their name, but the life insurance company was New York Life. I interviewed with both and I took a job with the Wall Street firm. But in that job with the Wall Street firm, I really didn't like it. So I ended up going back to New York Life, and I spent 14 years at New York Life, and a couple of years doing life insurance. But then the majority of my time there was spent in the RIA division called Eagle Strategies. And I did very well. So through the 2000s, I stopped working in my stores and I started working in Wall Street and doing the advisory side, and I was crushing it. I loved it. And I made a ton of money doing this up to 2008 when the Great Recession hit. I was what I would say, I felt like I was on the top of the world. I was making a lot of money. I was flipping a few houses, and I even bought a strip mall. Well, it wasn't a strip mall. It was a dilapidated paint store that I was going to convert to a strip mall. And then the Great Recession hit. And that Great Recession took me straight to the bottom, literally just plummeted me to the point where I was one payment away from being completely bankrupt because I owed this guy $370,000. He was a hard money lender and not a nice one, to say the least. And I remember the night I came home, my girlfriend had just moved in the house, and I said, "Sweetie, I need your help. I need your help paying the mortgage. I need your help paying the utilities. And by the way, I got to move my 2 friends in because I can't make it." Now, most women or most girls would have just ran out the door, but I think she kind of liked me because she stuck it out. She did help me pay all those bills from her bank job she had. And that's where we get into the fun stuff, because after that point, I dove into real estate and I started buying apartment buildings. And I did that up to 14, where I got up to 36 units. And then all of a sudden, my 37th unit, the bank said no. The bank froze my lines of credit. There's a lot to that story, but we'll just kind of glaze over it. And then all of a sudden, I had to sell everything off, including the dream house that me and Larissa had bought. Now, sometimes in life, when you hit the bottom, every one of us has a different bottom. When you hit that point, you start questioning everything. And that was me. I was questioning my advisory position. I was questioning my real estate holdings. I was questioning everything in my life, including my own life, which landed me in an event. And I remember this event was a house flipping event because they were giving away a free iPod shuffle. And 2 guys started talking. Okay. But these are 2 of the main speakers. Mike and Greg were their names. And they started talking about money. Now, remember, I'm at this point 14 years into the financial advisory world. I felt like I knew everything there could be to know about it, the advisory world. Sometimes, as you probably know, Jack, a lot of advisors get a bit of an ego when they start doing well. And I certainly had that. Now, I'm the most transparent to discuss that. So once you start hearing somebody talk about money in my capacity, I'm like, no, this is weird. They're talking about the complete opposite of everything I'd learned about money in the advisory world. But you know what? I was at that low point. So I was willing to listen, and I dove in and I started following them around to learn, what did they know that I wasn't taught in Wall Street? How are they doing these things, which to me made sense, but made no sense. And Jack, when you kind of saw what I do, same thing, right? And well, both of you really, I mean, Alex, you said it sounded too good to be true. Well, this sounded too good to be true to me because all I knew were stocks, bonds, mutual funds, and, some life insurance and annuities. What happened next was probably the most profound thing. Is I started working with these 2 guys and I started meeting all their friends, which were all multimillionaires. Even some billionaires were in that mix. And, billionaires, you'll never know they're a billionaire until somebody else says, "Hey, do you know he's a billionaire?" And you're like, "That guy? No." Absolutely. Billionaires don't look like billionaires. They actually look like your next door neighbor. If you've read the book, The Millionaire Next Door, like that's the billionaire next door too. Like, I'm sorry, until you see their house in their bank accounts. Like, that's the thing. And when I started meeting all these people, I was good enough to talk about money because of my position. So I started asking them all. I started asking them, what do you do with money? Kind of like that guy, Daniel. I don't know if you're on TikTok or Instagram, but there's this Daniel guy that goes around and asks everybody, I like your car. What do you do for a living? Right? That was me with these people, asking them, how did you do this? What do you do with money? And I started seeing a very, just an unignorable pattern in these very wealthy individuals. And every one of them kind of had a different way of explaining it, but it was all privatized banking. It was these specially designed and engineered whole life insurance policies they were using. And they never called it whole life because they were like, they've gotten past that level where they're talking about it like regular people, but it was. And I started seeing this pattern and I'm just like, wait a second, all these guys are doing what Greg and Mike are talking about. Like, why is it that I don't know about this? It upset me to a level. This is the same thing as BOLI, which is bank-owned life insurance. But if we were to teach you about this, as you know, all of you advisors would have to take a cut in your pay of roughly 60 to 90%. So it's already hard enough for us to keep advisors past 5 years. And Jack, you know this, because most advisors die in year 1 or by year 3, like you can get rid of 80 to 90% of them. There's only 10% that make it. So he said, if I had to tell them all to do this great thing and talk about this great thing, I'd have no one left to even sell regular life insurance or sell term insurance or sell these stupid annuities and investments. And I said, John, you made a good point. You see, banks are the number 1 purchasers of whole life in the world. And all these wealthy individuals were using this. But the first thing I got to be clear about, and we're going to get into questions, is this isn't a normal whole life policy. I'm just calling it what it is, because you know what? If you went out and bought a Ford Focus, and then you looked at Ken Block, who's a rallycross driver, and you looked at his Ford Focus, they're both Ford Focuses. But one does something miraculously different than the one you bought on the dealership floor, right? It goes 120 miles an hour sideways in full control, but it's a Ford Focus. So when I talk about whole life, people need to understand that this isn't the whole life that you buy from your brother-in-law, or this isn't the whole life you buy from the life insurance store. This is very specially designed and engineered, just like that rally car, that Focus rally car. So I guess I'm just going to stop talking and let's get into some questions, because the best way to get into this is really to hit some of the negative beliefs. The Dave Ramsey and Susie Orman talk out there. And Dave Ramsey has no clue what we do, even though he thinks he does.
So, well, I guess on that, so Dave Ramsey's always like, buy term life, invest the difference, term for the same amount of death benefit. The premium is a lot cheaper, but this is only 10, 20 years of term. So what would you say to Dave Ramsey if you were on here right now?
Well, first off, Dave Ramsey, I'm a huge Dave Ramsey fan. So first off, I'd say thank you for helping millions of people escape the debt trap. That'd be my first thing I'd say. The second thing I would say is, Dave, I own a ton of term insurance, and I always will have term insurance to protect the things that have a term of time that I am at risk. And I would then explain, Dave, you are clueless as to what infinite banking concept is, and you are clueless as to how privatized banking policies are even built. Because if you knew what they were and you knew how they were designed, you would be the biggest fan, because you know what they include, Dave? A whole bunch of term insurance. Because in order to build these policies the way we do, we have some specific rules. And I'm not going to get too deep into this, but when somebody comes to us to set up a banking system, i.e. especially designed and engineered whole life, they don't tell us, hey, we want to buy $500,000 in life insurance. I would be confused. I would say, you know what? Well, maybe you should go to the State Farm agent, or you should go to that New York Life agent, because we don't do that. We don't sell term insurance. We don't sell universal life. We don't sell IULs. We do one thing and one thing only, and that is build banking systems. Then what I would then have to explain to Dave is I would have to say, Dave, what we do is we ask somebody how much they want to put through, how much of their capital do they want to put through this private banking system. And really, it's just changing one thing. Every single person I meet that I talk to is usually saving money. So all we do is we change one thing, and that is where their money goes first. And we'll cover that. But by changing where their money goes first, we have to create this banking system, this whole life policy, but we do it by using the lowest death benefit. So actuaries, like, you're looking at that. We put the lowest base death benefit on the policy possible because we want the lowest cost. And then what we do is based on the amount the client wants to put through their capital, they want to run through this system. We support the MEC rules, which is called the Modified Endowment Contract Rules. They're technically IRS rules. We support that death benefit with nothing other than either 1 year renewable term or 7-year term. Now, Jack, you know exactly why we use 7-year term, because in the 8th year, we no longer need the term insurance. So it's gone and all the cost of the term insurance is gone. And then we're left with this small base policy, but that small base policy is increased tremendously because the main place we put our clients' capital is into the insurance company's general account through a special rider called the paid up additions rider. Sorry, I went deep into that because you understand it, Jack.
I guess along with the MEC rules, you do bring up like Walt Disney, for example, how he funded this huge project. Now, back then, the MEC rules didn't exist. Is that correct? And then I guess if you could speak on that, how they've kind of changed and how you see it changing in the future.
Yeah, it's an awesome story. I mean, you can go back to the Rockefellers, the Rothschilds, you can go to, Ray Kroc, you can go to Walt Disney. I mean, all of them started these whole lives back in the day. Now, they were different back then because there was no rules. The IRS, you see, life insurance, whole life insurance specifically, I got to be clear about that, has been around prior to the tax code being written. So because it was around since, before the tax code was written in 1913, all the people that had money, and let's just focus on Rockefellers and Rothschilds, where do you think they put all their money? They're the ones that created this banking system because they didn't trust banks. So they started using insurance companies. So when the time came to write the tax code, what the big old guys do down in Jekyll Island, they all were like, hey guys, you guys got these whole lives? You got money in those too? You're all using life insurance, right? Let's just bypass. And I don't know if this is factual. I'm just making fun of this. Let's just bypass this because if anyone understands how these vehicles work, they are potentially tax-free. And that carried on all the way until 1988. Think about that. 1913 to 1988. These things were just like unlimited. You can put any dollar amount you wanted into a whole life insurance policy, including these specially designed ones, and not have to worry about any IRS regulations. 1988 comes around. And prior to 88, the oil tycoons and the oil industry, if you remember the 80s, they were crushing it. They were putting billions of dollars through these things. And the IRS got wind of this, saw this, and was like, oh man, guys, you're really making some noise. People are seeing what you're doing. You're putting your money, all of your capital through these whole life policies, and everybody knows these things are tax-free. Like the IRS can't allow this. So the IRS had to put rules in, and they put the MEC 7 pay rule to limit the amount of money these wealthy individuals could put through the policies. And that limit became what it is today, which now we're fighting the MEC rules, which is about to change in 2022 with this new 7702. We're going to be able to put a bunch more money into these things. But the wealthy people said, you know what, we're going to just find a way around it. So they just created trust. The trust owned the life insurance, and then they could put any dollar amount they wanted through them anyway. So it's just it just hurts us little guys.
Can you explain the trust thing? So like, why could the trust put any amount in where an individual could not? Sorry, if that's a real ignorant question.
No, it's not ignorant at all. It's just a long, lengthy question. And I don't want to go too deep down that rabbit hole because it's high level. So when, wealthy individuals, there's no secret, you've heard it in the news from Warren Buffett to Bill Gates to Ray Dalio, any of the wealthy ones, even, our ex-president Trump, like they don't pay much in taxes, but why? Are they doing something illegal? No, they understand the tax code, or they have advisors that understand it. So what they do is they set up what's called trust and foundations. They usually do family trust and a complex trust. And they have these trusts set up, and then they funnel money through foundations, and it's called 1041 tax reporting. So why is it that they don't have to pay taxes, or why they can overfund these whole lives is because when the trust owns it, it doesn't fall under the same rules you and I have to deal with because of the 1041 tax reporting. So because the trust owns it and they just know how to funnel the money, it's just a different set of rules in how they work. Now, I never knew this until the last few years when I started really diving into, wait a second, why did these guys not pay much in taxes? I bet you we can do the same thing. And yes, we can, but you really got to have a tax liability over about 100,000 per year to really have the 1041 tax reporting make sense.
Okay.
So again, I just didn't want to go too deep down that. Jack, I don't know if you want to add anything on that.
I guess with the rule changes, I know a lot of the examples in your book talk about the guaranteed crediting rate of 4%. Mm-hmm. I know that's about to drop, but I also heard the loan rate on a lot of, taking out loans is going to drop possibly. I guess if you could talk a little bit about that and how you see the usage being affected.
Sure. I mean, it's no secret. We're in 2021, just after COVID. We're in we are in the lowest interest rate cycle, I think of pretty much all of our lives, and even, many generations of lives. So, when it comes to the guaranteed crediting rate that insurance companies pay in the contract, it is a 4% guaranteed rate. Has been as far back as I've been in the industry, so the early 2000s. So now that some of these insurance companies are struggling to look at future obligations at 4%. So what's happening now is the government has approved 7702. We're definitely not going there, but all it is it's basically just giving these mutually owned and insurance companies the ability to reduce their guaranteed crediting rate, the guaranteed interest rate they pay. How much is it going to reduce to? Well, I can only tell you what I've heard so far. We won't really know until probably January 1st of 2022, but some companies, and they're all going to follow the leaders. Who are the leaders? The big dogs, the Mass Mutuals, the New York Lifes, the Northwesterns. Those guys are going to be the trendsetters. So I've already heard Mass Mutual is going to have a product still holding 4%. They can do that. They're very large and have plenty of surplus. But I think the rates will come down to 3.5%, maybe 3%. It's going to vary between different insurance companies, but pretty soon what you'll see, just like always in the financial world, is once the big guys set their rates, everybody else will fall in line. And you'll see kind of some turbulence in 2022. But let's talk about, that seems like a really bad thing. And, I'm not saying whether it's good or bad, but let's look at the silver lining behind this. Let's just say the interest rates on these insurance policies drops from 4 to 3. Oh, boo-hoo. I mean, is anyone else getting 3% guaranteed contractually from their bank, from their CDs? I don't think so. So it's still better than every single thing out there. Okay. Then everybody's like, oh, it's not better than Wall Street. Listen, Wall Street is definitely not guaranteed. And if that's your attitude, we should study 1926 to 29 to know what's going to happen next, because that sucker is going to fall apart quick. Anyway, but back to the loan crediting or the loan interest rate. So if we're getting 4% and we take a loan from these policies, the insurance company charges us 5%. Most people, when they hear that, they're like, wait a second, so I'm losing 1%. That right off the bat tells me whoever hears that, they don't understand compound interest. And they also don't understand that mutually owned insurance companies, which we use, pay dividends every year and always have. So I'll pick on the big one, and I probably shouldn't use the name, but it's okay because it's factual. Mass Mutual. They pay 4% contractual, just like all the other ones we use. And then they pay a 2% dividend, which is the lowest dividend in 31 years. But that's still 6%. So if you're making 6% on your capital and you take your capital out of this insurance policy, let's just say 30 days later, you're paying 5%. Like, that's still a good day in the office. I don't know a bank out there that allows you to make a deposit, pays you interest on your deposit, lets you take that money out and still pays you 1% on it. Heck, gentlemen, either of you getting 1% in your bank right now?
Right.
I am not.
Precisely. So now 7702 comes. Let's say the rate goes down to 3. Well, what will happen is the same thing will adjust with the interest on the loans. So if the interest comes down to 3 guaranteed on your money, the loan interest rate is going to come down 1%, because it's always been about 1% spread. That's kind of how the insurance companies do it. I don't know the logistics behind that or why, but so that's what's going to happen. So if it comes to 3.5, interest rates will come from 5 to 4.5 on new business. And also, I want to be clear, this isn't for any business that's in force. That block of business, everything prior to the 7702 coming into force, will remain. So if you got 4% in your contract, obviously it's not going to change. New contracts will. The other thing too that's pretty interesting, and I got to be careful how I say this because I don't have any factual data to say this, but if this goes through, my thought is insurance companies will become even more profitable than they are now. because they don't have to pay as much. And their 30-year treasuries, their perpetual tailwind behind them, now have the ability to do more work for them because they can lower their interest rate. So insurance companies become more profitable. And let's just say claims, the claims remain even to what they are now. That means no new people are dying. Well, we would have saw that for COVID, but let's just say that stays the same. Insurance companies, if they're more profitable and their claims stay the same, they'll probably pay higher dividends. So if they drop the guaranteed interest rate, their profits go up, they pay more in dividends. So there is a lot of talk that dividends might go up, which will be a really, really good thing. And then also because of the 7702 and the drop in interest rates, we're going to be able to stuff a lot more money into these contracts than we can today under the MEC rules. Sorry, that was a long-winded answer.
That's cool. So going to the MEC, what is the current amount that you can put in a given year, I guess? And then with this new change, like, I guess, how much more would you be able to funnel through the whole life policies?
Sure. Well, let's hit the max and the minimums first. I think a lot of people are probably thinking that the maximum you can put through one of these specially designed and engineered whole lives, and I think this is any life insurance policy, is $5 million per year. That's your max. How much is your minimum to do the policies that we set up? Take your age. So I'm 43 years old, multiply it times 10. That means it would be 430. 430 a month would be the minimum amount somebody could do to set up one of these private banking policies. Now we got a minimum and a maximum. So then you ask, well, what are the, how do the MEC rules? It's really just, it's like hitting a moving target. There really isn't a set amount. It's just somewhere within that minimum and that maximum based on your income, based on your net worth, and based on what they call your human life value. You can put any dollar amount you want in. The only thing you have to understand is the more you put in, and there's way more to this too, because if you do dump-ins, but the more you put in, the more death benefit we have to meet those MEC rules. So if we dump $500,000 in, we have to have a higher death benefit to support those limits. But that's okay, because again, remember how we do it is we put a whole bunch of term insurance on for the first 7 years, and we still maintain a fairly low base amount, which keeps our cost of the policy very affordable. Unless somebody's really, in the later stage of age, this really isn't very effective for people. I'd say 65 and up. It gets tricky for us to make these things really efficient. But anyone 65 and under, man, these things are unbelievable machines.
Yeah, I guess, part of 7702 like defines what life insurance is. And there is a ratio of like your account value to death benefit. And that's what Chris is touching on there.
Yeah. I mean, we could get super technical.
Yeah.
I try to keep everything at like a 5th grade level. We're at like a 12th grade level right now, but that's okay, because we're having fun with this.
So I was just going to say, I'm still a little confused. So why, and I'm sorry if you said this and I just didn't understand, but why are you putting the term policies in the whole life, or why are you adding the term policies on in the first 7 years? Or isn't it like somewhat redundant, or am I just not understanding?
Yeah. Well, typically our client would never really care about the term insurance or the base. I'm just trying to really unravel this whole thing and kind of get in the weeds a bit. So term insurance, let's go to Dave Ramsey. Why does Dave Ramsey recommend term insurance over all other insurance? It's one reason, it's cost, right? It's the lowest cost life insurance. So because we don't care about the life insurance in these contracts. We only care about the life insurance because the government says, the IRS says we have to have a certain, amount of death benefit on the policy to support this premium deposit that we're going to make. So if we're going to put, I don't know, pick a number, 10 grand, we're going to put 10 grand per year into one of these contracts, these specially designed and engineered whole lives. Based on $10,000, we're going to design the policy with the lowest base death benefit, which is the main part of a whole life contract. They call it the base. We're going to put the lowest base death benefit. But then if we put 10 grand with the lowest death benefit, we are going to have a MEC situation where the whole contract is going to be a MEC, and it's all going to be taxable, just like your investment accounts are. So to avoid the taxation, we have to basically make the plan meet the MEC guidelines. So if we want the lowest death benefit but the highest premium, well, we got to fill that gap to get to that level, that IRS level, that MEC 7 pay level, to make it work. Well, what's the best way to do that? That cheap term insurance. So that's why we put the term on. It's just to fill that gap so that we're in compliance. I guess it's not the right word. I'm trying to think of the easiest way to say it. Not in compliance, but we're above the MEC line. We're not MECing the policy. And to be funny, like if somebody sets up a policy for 10 grand, literally the most amount they can ever put in is 10 grand. If they put 10,500 in, your policy's a MEC. That's how close we build these things. We don't want any extra fluff, because that makes anything extra makes the plan least or less efficient. And that's all we do. We just build banking systems. So anybody that I've ever met that does, these policies for themselves, they care about how much money they have, not how much money somebody's going to get the day they graduate. Nice way of saying die.
Okay. Thank you. Yeah.
Sure.
Okay. That makes sense.
I thought it was really cool how you described in the book how I think it was Brent had like 19 policies, and he basically runs all of his family finances. Like if his son wants a car, he finances it. Can you talk a little bit about, I actually thought you might need some license to do loans like that. Is there, I guess if you could speak on that a little bit, how like if I wanted to open up a policy and then finance, my sister's car, or, tell all my friends, instead of going to their bank, come to my bank. Can you talk a little bit about
Sure.
that?
I think if we go to a CPA or something, I'm sure they're going to say, okay, well, you can finance up to 5 cars before you become a commercial car dealer or something stupid like that. But, so why does he have 19 policies? It's not because he wants 19. Why do I have 7 policies on my life and soon to have 8? It's not because I want 8. It's because over the course of time, okay, so take mine from well, it's actually longer than this, but just do 14 till now. Every single year, I want to put more money through my banking system, because as I put more money through my banking system, the number one thing that we haven't really covered is the mechanism of what the infinite banking concept is, but it's simply just every single one of you work for money, right? We work for these $100 bills, and these $100 bills means we traded hours for dollars in most cases. But what the problem is in this country, one of the biggest problems is we've been taught to make money by trading hours for dollars, and then to give up control of that money to somebody else, i.e. a bank, a 401k, a broker, a financial advisor like I used to be. And when you give that control up, it's not easy to get the control back, because nobody wants to relinquish control. The bank doesn't even like giving you your money back, for crying out loud. So the whole idea is we want to mimic what a bank does with money. We want to take the money that we earn, and we want to move this money as many times as we can, because that would basically be mimicking a bank. And if we can put our money into these specially designed whole lives, let's say just use this $100 bill. I put $100 in, and let's just say inside the first 30 days of the policy, when my check clears, I want to take some of that $100 back. So let's say I take $80 or $800 back of that, or $80. I got to get the math right. I put 100 in. Let's say I take $80 back. That $80 is not my money. My full $100 is still in the policy, earning interest plus dividends. So whose $80 is this? It's the insurance companies. It's from their general account. But the $80, they give it to me in the form of a loan, in which they charge interest on, simple interest. My money is earning compound interest. There's a big difference between the two. So if I've got $80 of the insurance company's money as a loan, most people stop right there. They're like, that sucks. I'm not trying to create more loans and more debts. Yeah, but this $80 in my hand is not a loan that ever needs to be paid back. Well, that's actually a lie too. It has to be paid back, but let me cover that. It is an advance of my death benefit. The insurance company literally just says, okay, this person has a death benefit that's going to be paid out someday when he graduates. So if we give him a loan, that $80, we're just giving an advance of the death benefit. So I have $80 in my hand that really came from my death benefit that's going to be paid out someday. So I don't have to pay this $80 back, because the insurance company doesn't care. They'll just pay themselves back the day I die. So like, how cool is that? I get to earn uninterrupted compound interest on every penny of that $100, while I still get to use all or even more than what I deposited every time I make deposits. So that's the magic sauce of how this works. And, going into that moving of money really comes down to just figuring out how to move that money and where to put that money. So I'm not dodging the question. I'm simply trying to take people back to understanding that the most important thing we do is give people a machine in which they can run their capital through and earn uninterrupted compound interest, but make money twice. if we're making money in the policy, okay, uninterrupted, and I've got $80 or even let's just call it $100 in a couple of years, because it takes a few years to capitalize your policy. It's not going to be, I put 100 in and I take 100 back out the first year. It's not going to work that way. It's usually 3 to 4 years for your policy to be capitalized, which means in the third year or fourth year, every penny that I put in, I can take out more than what I put in. And that keeps going for the rest of your life. Study uninterrupted compound interest. You understand that. So then it just matters, where do I move this money that I have? Well, do I pay off loans? Do I pay off credit cards? Do I pay off my cars and then recycle and recapture? There's just so many things you can do with this.
I guess if you could clarify a little bit, when you say simple interest, so if I take a loan out for $100 at 5%, simple interest would just be $5 per year if I'm not paying it off. Is that actually how it works?
Correct. Absolutely. Yeah. So it'll build, because, it's, $5 one year, $5 next year, $5 next year, but that's the simple interest part. So once you understand that, keep going.
So just to clarify, it is not, so if I decide not to pay the loan back after the first year, it builds to 105. It's not, then the second year, it's not 5% of 105. It's just $5 each year.
Yeah.
Really?
Yeah. But your $100 that's in your account is compounding. So that's, the first year that you have that's, $100 that you put in. Let's just say let's just use the same $5. Okay. But the next year you're compounding on 105. And then the next year you're compounding on whatever that is, 107 something, and then so on and so on. It just keeps going, but it perpetuates faster and faster. It's why Albert Einstein called it the eighth wonder of the world.
But the loan part, that is actually not compounding.
No,
it's simple interest. Really? Mm-hmm. Okay.
Yeah.
Cool.
I could go in the other room and pull out all my loan statements and show you that the loan amount, if I don't pay the loan back, the same amount is charged, because the insurance company looks at the amount of the loan at the beginning of the year and they just say, okay, the full amount of interest that we're owed is this much. And then, but also let's be clear about one thing. If you follow what the infinite banking concept is, you're always paying loans down, because you're always taking money that you've made or freed up on the other side that you use that $80 for, and you're recycling and recapturing that money back into your policy, which is paying the loan down, constantly decreasing the loan, increasing the amount of money you have to use, and just keep cycling that over and over and making money 2, 3, 4, 5. Sometimes you can make money 5 times on the same transaction, because you have one place that never stops earning interest on.
So I guess this is actually one of the first things I think I sort of thought about when I heard you talk about having multiple policies. Do you just take a loan out from like one policy and then just immediately funnel it through all of your policies and then just no
way. No. And there's, and this is a long conversation, but yes, a lot of people out there are having people set up a policy. They're having them take a loan from one policy and put it into another policy. Now, to me, and Jack, you correct me if I'm wrong, that is the definition of churning, bud. That is like, I'm doing that to create another commission and another commission and another commission, even though our commissions suck, because we give up 60 to 90% of our commission so that our clients have access to 60 to 90% immediately. It still is not the way that I do it. So I will typically, so let's just, we were talking about why do we have so many policies? I have so many policies because each year I want to put my money through the policy, as much of it as I can. But if I got to abide by the MEC rules and I have a policy set up for, let's just say $15,000 a year, and it doesn't matter how I get that 15 grand in there. If I have the ability to put 15 grand in, I can't put 16 in, I can't put 20 in. So the next year, I might want to put 20,000 through my banking system. Maybe I made more money on a loan I did. Maybe I paid off a credit card and I recaptured the money I used to give Visa. If I want to put more money through my policy, I can't do it. That I'm restricted to that. Sure, I could pay the loan down, but if I want new monies to go into that, I have to set up another one and then another one. And just in full transparency, my first policy was about $225 a month. That's how small it was. So don't ever think there's too small of a policy. There's a lot of guys saying, oh, if you can't put, this much through the policy, this doesn't work. There's a bunch of guys out there saying that. It's because they want big clients. They don't want to deal with small clients. My first policy, $225. My next policy was like 500 and change. And then after that, and they were all monthly deposits. I just kept climbing and climbing and climbing. And now the policies I do today are between 30 and 50,000 when I set up a new one, except for my daughter's, which is only $5,000. So you can see, like, I'm not putting new policies in force to fund future policies. If I start a policy, let me just give you an example. If I start a policy for just think 10, let's just use 10 grand. It's easy math. I got 10 grand in this policy. Well, immediately I might have between $8,000 and $9,000 of that 10 to use. So what I'm going to do is I'm going to take that 8 or 9 grand. I'm going to say, where can I make the most return on this? Let's just pretend that I had a Visa credit card, and I was paying Visa 20%. I take that, let's just use 8 grand. I take the 8 grand, I pay off Visa. Well, let's say Visa was, I was paying them $100 a month. Well, if I pay that $100 a month back to myself, that's like earning 20% because I was giving 20% away to Visa, right? Fair enough.
Yeah.
So if I pay myself back that 20%, that's found money. Now, can I put some of that back into my policy as a loan repayment? Absolutely. But how much was the loan interest rate on my loan? 5%. So if I pay back 20%, do you think I'm going to eventually pay that loan off and not have anywhere else for the rest to go? 100%. So that's just a very simple way. Now, that's not how I use it today because all my loans are paid off, but I use it to lend money out. I use it to buy real estate. When COVID hit and the markets tanked, of course, I bought stocks. I bought all sorts of stocks then. I'm not buying any stocks now because I'm waiting for the next dip. But I'm always looking for where can I move my capital, where my capital, my money can work harder for me. And when my money's working harder, doesn't matter if I work any harder at all. I don't have to work any longer. I don't have to work overtime. I don't have to take on any more risk. But if my money's out there working harder, it's generating more income for me. And that additional income, I don't want to leave that in somebody else's bank. Man, I don't trust regular banks. I'm sorry. I just don't. And I don't like the fact that they make 400 to 1,300% more than I do on the money that I let them hang on to. It just doesn't, I'm so deep into this. Like, it's very difficult for me to look at the old way I used to do things. So when I look at my capital, if I've got more than 10 grand sitting in any traditional bank, dude, I get goosebumps. The hair on my arm stands up and I'm like, oh God, I got to get that money out of that bank because they're doing me no favors. So I want that money into my banking system. And to do that, I have to keep opening more policies if I want to run more money through them. Does that make sense?
Yeah. For the most part, yeah.
I guess
Yeah.
if you could touch on the risks a little bit, like if someone were to say, okay, I want to put $5,000 a year in, let's say, so it is a fixed amount. So let's say the second year, they can't do the $5,000 for whatever reason.
Great question.
So kind of walk us through like the mechanics of what happens to the policy in that case.
And listen, this will happen because our lives, things change. So let's just go back a year ago. Let's just say somebody prior to COVID set up a policy for 10 grand. And let's say they went the first year, they put their first 10 grand in, but then the second year, COVID kicks in. They lose their job. They no longer can put 10 grand into the policy. They're in a tough place. Like, oh my God, I set this awesome plan up, but now I can't fund it at the 10 grand I set it up at. No big deal. Listen, when we build these plans, again, remember I said the max you can do would be that 10 grand. Okay. That doesn't mean that's your minimum. Your minimum could be as much as 90% less than that 10,000. So your minimum might only be 1,000. Most of the plans we set up, it would be about $4,120. So if you put 10 grand in, the minimum amount you can fund your plan, just for all intents and purposes of today's show, 4,120. Why the weird number? Well, because we don't want to lose the ability to put 10 grand in again. So the insurance companies mandate that we put at least $10 a month or $120 a year into this special rider called the paid up additions. So no big deal. If somebody, the only time somebody would get in trouble. So let's talk about a risk. Okay. Here would be a risk. Let's say you set up a policy to put $500 a month into one of these policies. 6 months down the line, you can't do the $500 a month. I hate to say this, but that's going to be a bad day in the office for you because in the first year, there's a few insurance companies, but let's just keep everything equal. You can't change the amount you're funding it at. And in your first year, you're just starting to capitalize the banks. You don't have a lot of capital in there to fall back on. So if that happened to you, then that would be bad. We'd have to go back to the insurance company, ask the insurance company to reduce your death benefit to get you to where you can, or you'd have to surrender the policy, which indeed in the first year, you would lose money. You'd probably in your first year lose anywhere between 10 and 40% on your money if that happened. That's the worst case scenario. And you know what? The good news is out of almost 3,500 clients, I maybe have seen that one time. And it was an unfortunate situation, but most people will fund their first year. And then the second year, it happens all the time. I just had it happen last week. The person was like, hey, I set this plan up for 30 grand, but I'm going to be short. No big deal. Like they call us, they think it's a big deal. Like, oh, I can't do this. Like, oh my God, what's going to happen? What are my options? I'm like, what do you mean? What are your options? Like, how much do you want to fund it at this year? Like, if you can't do 30 grand, how much can you do? Oh, I don't know. I could probably do 15. Oh, good. Then do 15. Oh, I can do that. I'm like, oh man, you didn't listen to me the first time, but that's okay. Cause I know you were excited. So yeah, we build these plans with tons of flexibility. If somebody has like wild income, let's say a real estate agent or a car salesman, right? Their income can fluctuate with commissions. So we'll build their plan maybe with a 90% variance, meaning they might do 10 grand and their minimum might only be 1,120 because they need that variance. So each plan is designed differently. There isn't one like off the shelf, like, oh, this plan's the best plan for everybody. No, we have technically 4 different designs that we do, but we can even we could probably get all creative and get hundreds of thousands of different designs if you really get down to the math of it. But we build every plan for that particular client's needs, goals, and the main thing we want is the policy to solve some money problem for that client. And I'm not saying that policy is going to solve every money problem. We might have to set up another policy to solve a different money problem later. But the first plan is going to solve the most evident and most critical money problem for that client. And that's how we're going to design it. You realize, gentlemen, I've never gone this deep into this stuff. I really feel like I'm doing it because, obviously Jack's, got a lot of experience in this, but your audience is probably going to get too much info. So it's going to confuse them. But like, I just want to make sure that like, if they get confused or this is like so over their head, just go back to my 90-minute video and watch the basics. Cause we are definitely getting in the weeds on some fun stuff here that I never get to talk about. So I just want to be transparent about that as well. So Alex is probably like, dude, I have no idea what half of this stuff is.
Yeah. I mean, most of this is honestly over my head, but it's still fun to hear you talk. So
yeah. I mean, everyone's, when it sounds too good to be true, everyone starts picking at it and we're trying to find issues. And I actually looked to see if I could find a mutual insurance company going out of business. And I did find some, but it looked like the policies that they had were absorbed by other companies. So it seemed like those policies were fine. I guess, could you talk about that risk a little and how?
Oh my goodness. Yeah. It's almost a non-issue and I do get people asking, well, what happens if Mass Mutual goes out of business? Deep down inside me, I'm like, okay, there's way more things going on if Mass Mutual is going out of business and we're not worried about our money anymore. We're literally figuring out what space shuttle is going to Mars and can we get on it? I'm actually not kidding about that. You see, people don't know, and it's not really something that's talked about in the news. People don't understand how big these giant mutually owned insurance companies are. Folks, listen, like, let me be clear about something. When a bank wants to build a giant skyscraper downtown, North Carolina or downtown Nashville, do you know where their money's usually coming from? Insurance companies. Insurance companies are one of the largest lenders to giant institutions like that because insurance companies have all the money. What money do banks have? Really, like, banks have your money, but banks move your money. Banks have 10% of every penny of your deposits and everybody else's deposits. That's all they have in reserves. So if there's ever a run on the banks like there was in 1929 and 1930, man, there's no one coming to save the banks. Oh, Chris, there's FDIC. Oh my gosh. Google that one and see how much money does FDIC have to insure all those bank deposits? Maybe 15 to 20% of all the money banks have. So banks are your worst bet. So insurance companies, let's just say there was a run on everything and, a complete collapse, which I'm not saying this can't happen. Insurance companies don't operate on that fractional reserve banking. Insurance companies operate on Austrian economics. Not going to bore you, but essentially a dollar is a dollar. If I promise to pay you $10, I have to have $10 in assets over here on the right side. Like, that's just how insurance companies operate. They don't operate on like, oh, I only need 10% for the, I need $1 for every $10. Absolutely not. So insurance companies have all the money. Insurance companies are very ultra conservative in how they operate and invest their money. Insurance companies don't go out and buy crypto. Well, Mass Mutual did take a pretty sizable position in crypto because I think they were just making a stand. Well, how much was it?
I think it was 100 million.
So 100 million to Mass Mutual would be the equivalent of like me and you putting $1,000 into something just to put things into grants. Like the idea that seems like a lot of money to Mass Mutual. That's like, let's try this little thing, Bitcoin. It might not pan out so bad, but insurance companies are the number one purchasers of treasury bonds, 20 and 30 year U.S. treasury bonds, which are guaranteed by the U.S. government. There is nothing really that you can invest money in safer than a treasury bond, and there's nothing more liquid. But they're boring. They're absolutely boring until you understand how they operate and how they work like insurance companies do. So if everything collapsed, what happens to your money? Well, if insurance companies actually are doing this dollar for dollar thing, well, you'd probably get all your money back. And even if they couldn't, some other insurance company would probably gobble up that small little mutually owned insurance company that's going out of business, Mass or One America or Lafayette or Penn or any of them. They'd come in and they would just absorb it, and they would do it very easily, and nobody would ever hear about it. It wouldn't be like the banks, oh gosh, WAMU's going down, or Merrill Lynch is going bankrupt. And then the Fed positions them and says, hey, Bank of America, you have to buy Merrill Lynch because we're bailing all you guys out. So you're, literally that's what happened in 2008 and 9. Like, don't make any two ways about it. You think Merrill Lynch is like this premier investment firm? They went bankrupt, folks. And they got bailed out because Bank of America was forced to buy them. Bank of America didn't want that dog beep, beep thing. Anyway, I'm going down a rabbit hole here. Insurance companies are safe. They're probably the safest place you can go. They also have state guarantees and federal guarantees, just like banks do, but they very rarely ever need to use them unless you're AIG in 2008, when they did go belly up because they were insuring things up to like 120 or 150%. That is not even feasible, but they aren't a mutually owned. They were a publicly traded insurance company that made some bad decisions, went belly up, got bailed out. And now today they're operating on the same risky business that they used to back in 2008 and 9. So we'll see what happens next round. Sorry, guys, I went way down the rabbit hole on that, but I had to bring that out because that's a great question.
Cool. Well, I guess we'll bring it back in. You did. We are a book podcast after all, and you do mention some other books in your book. I guess if you could talk a little bit about what inspired you. I mean, we could talk about Be Your Own Banker, the Kiyosaki book, or Tony Robbins book a little bit.
Well, for me, it wasn't Becoming Your Own Banker by R. Nelson Nash. That was the first one I read. I actually read Kiyosaki's Second Chance. Okay, everybody's probably read Kiyosaki's, his main book, Rich Dad, Poor Dad. But Kiyosaki's other book, Second Chance, he's got a few. But that book, I can't remember where it was in the book, but he talks all about privatized banking and the infinite banking concept. He doesn't sell it or do it, but he talks about using it. And then another book is the big guy, Tony Robbins' book, Money, Master the Game. I think it's section 5.2 or 5.7. He talks all about this. That guy's using this stuff. He's using investment grade insurance. He's absolutely positively using exactly what we've been talking about this whole time. Pirates of Manhattan, 501k from Ted Benna, the founder of the 401k, talks about what I'm talking about in chapter 1. He calls it the Swiss Army knife of the financial world. Like, come on, like the guy that came up with the 401k knows about this. Folks, they all know about this. They're just not talking about it because what do they have to gain by telling you what I'm talking to you about? Nothing. And then what does a financial advisor have to gain by telling you about this great system, this great thing? Oh, what do they have to gain? Yeah, a 60 to 90% cut in their commissions. You think they're happy about that? No, they're going to sell you an IUL that they're going to make 120% of your first year commissions. And I'm getting out of line with that because those can vary basically. But you just got to understand, sometimes if you just follow the dollar, you'll see the truth. It's right there under your nose.
I guess that's just from a sort of ethical standpoint, a little disconcerting. Like, isn't there almost like a responsibility to do what's in the interest of the client, like the best interest of the client?
Jack, you're laughing a little bit there, but listen, I'm going to try not to get myself to a level of such hatred from financial advisors, but let me just put it this way. Unless you are a fiduciary, an RIA or an IAR, where you are a fiduciary for your client and your client's money, that's when you absolutely have to act in the best interest of your client. I'm not saying all financial advisors don't live under a code and in practice under a code. Yes, they all have to do what's in the best interest for you, the client. But if you're not a fiduciary, there's some gray areas. And I will absolutely tell you, from being in the financial world at a very high level for 16 years, they don't all do that. They chase the commission. They chase the big payouts. They chase the big fees. I hate to tell you this, but listen, this is what's happening out there. This is why they recommend some of the products. Like if any of you have bought a variable annuity, I am sorry. You were the victim of a high commission. If any of you are buying IUL policies that are sold for short-term uses, I'm sorry. You are being sold a commissionable product because that advisor got paid a crap load of money. And if you're buying regular whole life insurance, regular whole life, that advisor is making 55 to 90% of your first year premium. That's a heck of a day in the office. Or you could kind of talk to people like me that do this privatized banking. We're making about $387 per 10,000, which is literally a 90% cut in commissions over what everybody else is making. It sucks for us, but we just had to realize that, hey, in order to do what we do, we have to solve a lot of people's money problems. And if we can help a lot of people, well, in scale, we make a lot of money, but only after we solve a lot of people's problems.
Okay.
It's a weird world, man. It's a weird world out there. The advisory world, it's kind of, some of it's like the wild, wild west in terms of the commissions. I mean, you can make a lot of money on commissions for selling people a specific product that pays you more. Heck, IULs. I mean, you could dial an IUL down to pay you like pretty much kind of like what we get paid. And you can scale that sucker up to really, I don't want to say it this way, but screw the client and make a whole bunch of money in a commission. And that should be regulated way harder and way heavier than it is. And I think down the line someday it will be, but not until the next market crash, when IULs are really tested in a true market crash environment. Like, and Jack, I don't know how long you were an actuary, but you remember VULs, variable universal lives? You remember how those things crashed and burned in 2008 and 2009. So you don't really hear about those little buggers anymore. It's because they didn't make the cut. Whole life's made the cut for hundreds of years. It's boring, but it's made the cut.
So I guess we'll start wrapping it up. Al, what were your what would you think after finishing? What were your main takeaways on this book?
God.
Or what are you going to read next to learn more?
I actually bought Be Your Own Banker and Money Master of the Game. So I'm cool. I'm about a third of the way through Becoming Your Own Banker. So probably finish up with that, but that's probably, and then Money Master of the Game is probably what I would go up with after.
And how do you like it so far?
Yeah,
I am liking it, but it's just learning more.
It is. It's a learning lesson. And add one more to your list, Alex. Add the and asset. It's a super easy read. It's literally called The And Asset.
The And Asset. Okay.
Yep. It was written by my friend Caleb, and great book. Great book.
Okay. Oh, Jack, what were your main takeaways, I guess?
I mean, I thought this was very cool. I actually really liked Brent's analogy of kind of changing I think it was like an airplane analogy.
Yeah.
Like just thinking more. Don't think about like moving faster. Think about changing your environment to get a tailwind. I think that's kind of my big picture takeaway.
It's my favorite one, man. Put a perpetual tailwind behind your money by simply changing the environment in which your money operates. Too many people are trying to make a faster plane when if they just change the environment the plane flew in, their plane would go a lot faster, a lot more efficiently. But unfortunately, that's not the way we're taught. We're taught to actually try to make the plane faster and fly in the wrong environment. And that is the biggest problem. And that wrong environment is when you give up control of your money.
Yeah.
Great analogy there.
Well, I guess with that, Chris, how can people contact you, and maybe what would be a good, I know you have that car YouTube video, like I'm purchasing cars with this. What would be a good place for people to reach out or start?
Yeah. I mean, the best place is my website, chrisnaugle.com. And on that website, we do a wealth webinar every Wednesday for free. And if you sign up for the wealth webinar, you just mentioned the car. So you get my brand new booklet. It's called Drifting Away from Traditional Car Buying, How to Keep Both Your Car and Your Finances in the Fast Lane. Essentially, that little booklet teaches you how to get all the money back for all the cars you will ever buy, drive, and own by changing one thing. And then in that, when you're on my website, just like we've been talking, we went really deep on some of these. So some of you are probably like your head spinning, but if you want to just get the basic, simplest way of what this does, on my website, there's a 90-minute video or a 10-part video series. If you can't sit for 90 minutes, watch that. And I promise you that video will bring it all crystal clear and show you exactly what this is and how it works.
Okay. Yeah. You want to take us out?
Yeah. So, Chris, it's been great having you. Yeah. And, as always, please reach out to us at brothersonbooks@gmail.com for any book recommendations, or if you would like to be a guest host for a particular book you have in mind. A great review or rating on whichever platform you're listening to would be greatly appreciated. And lastly, if you can think of any friend, family member, or coworker that might like this episode, please pass it along. And with that said, Jack, what book are we doing next?
We are doing, here, let me get it. The Wim Hof method. Very, very exciting. I'm starting to take the cold showers already.
The cold showers. You always got to shock the body.
Yeah. So with that, Chris, thanks so much. It was very fun. Hopefully we'll be in contact.
It was my honor and privilege. Thanks, gentlemen.
Yeah. It was great having you, Chris.
Yeah.
Thank you so much.
Yeah.
You're welcome.
Appreciate the time. Bye.